What is on-chain crypto analysis and why it is important? On-chain analysis is the method of using information from a blockchain ledger to determine market sentiment. More specifically, it involves looking at transaction histories and crypto wallet balances. So this exposes many metrics like volume traded, major trends or shifts in market confidence, the coin distribution among holders, and other technical dynamics economics-wise. There are many platforms that offer on-chain analysis reports or charts that you could use, like Into the Block, Nansen, Mizari, and my personal favorite, Glassnode Analytics. Each has its own unique features. For example, Into the Block offers price predictions, while Glassnode offers weekly insights on activities in the market. A side note, however, that some of these services require a monthly subscription to access other advanced signals or data points. However, the free version for starters is more than enough initially in your crypto journey. So how do we understand and apply on-chain analysis? For starters, Bitcoin is the most applicable cryptocurrency when it comes to on-chain analysis metrics due to its size, by market cap, and investor activity. Secondly, some graphs will incorporate technical analysis to describe the current landscape and situation in the beginning. So understanding terms like consolidation range, support, resistance, or retracements will be useful. There are 817 metrics on Glassnode alone, but the recurring terms you'll see in on-chain analysis reports regarding Bitcoin specifically and graphs that are the most important are accumulation and distribution, whales wallet inflows and outflows, exchanges inflows and outflows, short-term and long-term held coins, profit and loss of STH, LTH, and whales. So accumulation and distribution can be used to understand participant spending behavior and describe the market response to price action. For example, during periods of price dips where the price crashes, investors tend to accumulate more Bitcoin, and the sharper the price decline, the higher the rate of accumulation, while the distribution phase occurs during periods of lower volumes and volatility, like sideways trading after market capitulations. Whales inflows and outflows describes the wallet activity of individuals or organizations that have between 1,000 to 5,000 coins. This can be used to detect shifts in the market trends or expose any potential manipulation on the horizon. And it's important to note that deposits and withdrawals are definitely not related to price action, as in the period of October to November 2021 during the bull market, withdrawals to exchanges have been detected as they exit the space in the process of profit taking. However, before that, as the bull market progresses, the deposits of whales increases as they are entering the space. One event that increased outflows was during the Terra Luna price collapse, as big crypto giants that supported Luna, as Binance and some venture capitalists, had to liquidate their coins in order to offset losses, which is the most probable explanation, but as you can see, not a metric to totally depend on all the time. Exchange inflows and outflows shows us periods where exchanges have sufficient Bitcoin due to lower demand or scarcity during early and other stages in bull markets. If you tie whale and exchange activity together, you'll notice that they correlate during periods of high volatility. Short-term and long-term held coins are new methods to show different investors' state of profit and loss. So short-term holders are these that hold coins for less than 155 days, while for long-term it's more than 155 days. The way this better reflects the market dynamics of hodlers and occasional traders is that these coins transition from short-term held to long-term held by maturation, so day by day, to prevent market manipulation or data inconsistencies, and exchanges are excluded from this metric to increase reliability. So people who have deposited their Bitcoin on exchanges, they will not be counted as retail investors. You'll notice that long-term held supplies tend to decrease during bull markets for profit taking, while in sideways trading or bear markets, usually they tend to vary wildly. Also, this shows that long-term holders generally have a lower rate of loss than short-term holders in shorter time periods of between 6 months to 14 months. Because if you look at Bitcoin since 2009 till today, it has always been increasing. So even if you, for example, bought in 2017 and then the price crashed in 2018, in 2020 you would have recouped most of your losses if you bought at the all-time high. So that's based on historical data. What's the importance of crypto on-chain analysis? It's, in my opinion, not financial advice, a much reliable tool than technical analysis or any specific event in the market that you might hear about, either it's FUD or FOMO, for long-term investing. Now, couple this with news and research, an investor will drastically increase their chance of proper dollar cost averaging. When should they start? When should they finish? How should they spread their risk? And getting better results than just diversifying into random altcoins like we saw in the last bull run. People that, they don't understand what these altcoins are for or what their future might be, or dabbling with risky financial instruments like options or futures. And this allows more peace of mind, which I've been practicing since 2019 by adopting this method into my investing strategies, which is a shift in mindset compared to 2017 and 2018 for me in my crypto journey. I'll leave helpful links and resources in the description to help you to understand on-chain analysis. However, one note I want to say is that Glassnode Insights have their own YouTube channel where they go over the key data in each report released. However, I suggest that their videos should aid you in understanding on-chain analysis and then relying completely on it. And above all else, stay safe and stay profitable.